Hey everybody, this is take number 4. This is my fourth try to make this particular video. I keep having trouble with the audio. I thought it was a software problem. I tried a different software, still had trouble. So now I'm thinking maybe it's the microphone on my laptop, which is why I'm sporting this stylish new headset. So what I want to do is run through real quickly how the grades are determined for the BSG company performance. There's a document on Blackboard that spells all this out, but I know that some people prefer to be told things rather than having to read through them, and so I'm happy to do that. So, and you might recall, you may not, but way back at the very beginning of class, I told you that I want to be very transparent in that I don't want to just tell you what I'm doing, but I also want to tell you why, right? And the same thing goes for this BSG grading. Okay, so one of the things I have to think about when I'm grading the performance of your company is I need the grading to be reflective of the strategic foundation that we've talked about from the beginning. Okay, so remember, our objective is to generate long-term abnormal returns for shareholders. Okay, now the grading has to be consistent with that. I have to evaluate your company's performance on a criteria that encompasses that. Okay, so what you're going to see in the simulation, just like we talked about in class, there's a lot of different ways that a company's performance can be evaluated, right? So for example, one thing I could do is to say, if what we're interested in is shareholder returns, I'm going to look at your company's stock price at the end of the simulation, and if you have the highest stock price, you get the best grade. Okay. The problem with that is all the agency stuff that we talked about, right? So remember we talked about how CEOs do what's best for themselves, and in a lot of cases those decisions are not good for the shareholders, right? This is the same thing, right? You know that you're going to be retiring from this company in 8 years. The company does not blink out of existence just because you left. That's true in the simulation, sort of. It's true in the real world for sure. And what that means is you need to make decisions that are setting the company up for performance even beyond your time there. Okay, so that's one reason why we can't use something just like a snapshot of the stock price at the end of the simulation. The other thing is we're talking about long-term returns, not annual returns, not what happens in one particular year, but the performance you're able to create over time. Okay, so keep all that in mind. What that means is when you look at the reports that are available in the BSG, we're going to talk a lot about these later once you've made a decision and there's something interesting to look at in the reports. But for now, just notice that the page 1 here is the scoreboard, and it gives you a lot of different performance metrics relative to your simulated company. The first set of metrics you're going to see here is the annual scoreboard. So for year 10 and then year 11 and then year 12, you're going to see what your company's performance is relative to the other companies based on the investor expectations, best in industry, weighted average. More on those in a second. I'm just pointing this out to say that this is not what the grading is going to be based on, okay? Because this is a snapshot of what happened in 1 year, okay? Our grading is going to be based on this game-to-date scoreboard, which is a more comprehensive measure of how well your company has performed over time, okay? Even still, here you've got multiple columns. This first column, the investor expectation score, that's all about how well your company is doing relative to these basically stock analysts, what they want you to generate in terms of earnings and these other things, right? Now, if you remember what we talked about in chapter 2, the fact is in some industries, in some environments, it's relatively easy to generate returns. In other industries and other environments, it's relatively hard, okay? So this investor expectation score is not going to reflect on your grading whatsoever. It doesn't matter whether you're doing what the analysts want. What matters in a competitive strategic context is how are you doing relative to the competition. That's actually captured in the second column, the best in industry score. Okay, so for our purposes, the grading is going to be based entirely on this game to date best in industry score. Okay, I'll tell you more in a second how that's determined. But these other columns, the weighted average, the bonus points, the overall, none of those have any bearing on your grade whatsoever. Okay, so let's say, for example, and I think we're seeing a pretty good illustration of this right now in the real world. Let's say this particular industry that you're competing in develops in a way that's very difficult to generate returns. Okay, Everybody in the industry is facing those same environmental conditions. They're all operating in the same industry. Okay, for our purpose, what matters is how well do you do given that context, right? You're facing the same conditions as everybody else. If you can outperform them in those conditions, that's how we're defining strategic success. Okay, so the game to date best in industry score, how well do you do relative to the other companies in the industry over time? Right? And just to be clear, the other companies in the industry, those are the other teams in your section of this class. You're not competing against anybody else except for those people that you were sitting in the room with for the past 8 weeks. Okay. How is the game to date best in industry score determined? It's based on 5 metrics. Okay, and I'll just show you real quick here. The 5 metrics that go into determining the game to date best in industry score are your earnings per share, your return on equity, your credit rating, your image rating, and then also your stock price. Okay, stock price isn't here, but the other 4 are shown in this box. Now, since I'm pointing to this box, I'm going to refer you back to the other video that I posted, which is called Beware the Projections, which is all about this box. There's some important sort of caveats that you need to be aware of. Okay, but for the game to date best in industry, it looks at how your earnings per share over time compares to your competitors. How does your ROE over time compare to your competitors? All right. And obviously that score ranges between 0 and 100. I don't know if that's obvious, but it does. Okay. One more quick thing just about and I want to come back to how I translate that to a grade in a second, but just one more quick thing about the disconnect between the annual performance and the long-term performance. What happens fairly commonly. Now, every time the simulation runs, it's a new industry, it's a unique context, and so every industry develops differently. But there is a fairly consistent pattern that I see where companies which start off at the top of the rankings in the best in industry score end up near the bottom. And oftentimes companies that start off near the bottom of the best in industry score end up at the top. Right? And if you think about it, that's not that hard to understand, because how do you look really good this year? Well, you manage this year's numbers, and then you try to manage next year's numbers, and then you try to manage the third year's numbers. Okay? That's likely to work in the short term. The problem you run into, though, is that kind of approach usually loses out to other companies that have a long-term plan, right? Companies that are making smart investments right from the beginning to put themselves in a position to achieve long-term success. So maybe I'm sacrificing year 1 performance because I know it's going to put me in a position to achieve competitive advantage over the long term. Okay, so always keep your eye on the ball. Always remember that this is strategy, that what matters is the long-term performance. Okay. So game to date, long-term, best in industry ranking. How do you compare to the other companies in the industry based on earnings per share, return on equity, credit rating, image rating, and stock price? Okay. Hopefully you see that's a pretty good reflection of your ability to generate long-term returns for the shareholders. Earnings per share, return on equity, stock price are direct reflections of that. And those 3 are very highly correlated. They're not exactly the same, but they do bear a close relationship with each other, right? Something else to note, those 5 metrics, none of them are market share, okay? None of them are revenue, right? So in a later video, when I talk about some lessons you can learn from past semesters, I can show you a specific example of a company that had relatively low volume. They had relatively low market share, and yet they did exceedingly well when it comes to earnings per share, return on equity, credit rating, image rating, and stock price. Okay, so just keep that in mind. Now, that's the game to date best in industry ranking. I have to take those scores at the end of the simulation, which range from 0 to 100, and I have to translate that to a grade. Okay, so here's how I do that, right? So let's say in this industry, this semester, you end up with the game to date best in industry score, which is the highest in your industry, right? And here, let me label my axes here. Game to date best in industry score. Let's say the highest one in the industry, that company ends up with a 90 out of 100. Okay, if that's the highest game to date best in industry at the end, that company is going to earn a base grade of 100%. Okay, there's 200 points on the syllabus for the performance of your company. This company would get 100% of those points. All right. Now, let's say this is the company that has the lowest game to date best in industry score, whatever that number is. But let's say, just for this illustration, let's say that their game to date best in industry is a 10. Okay. The company that has the lowest game to date best in industry will have a base grade of 70%. Now I'm saying base grade because there is a modifier that I'll talk about in a second. Okay. Now you got to deal with everybody that's in the middle. All right. The way I do that, the grades of the companies that are between first and last depends on where they are between first and last. And I don't mean first place, second place, third place, fourth place. I'm not talking about the ordinal ranking, right? What I mean is, how does your game to date best in industry compare to first and last? Where does it fall in this distribution? Okay, so the easiest illustration would be to say, here's a company that achieved a game to date best in industry score which was exactly halfway between first and last, so it's 50 in this illustration, right? That team would get a base grade that's exactly halfway between first and last, so they would get a base grade of 85%. Okay, now it doesn't matter, this team right here that's got the game to date best in industry of 50, this team may be the second place team because all the other teams are down here between them and last place. Okay, this team could be the 10th place team because all the other companies are up here between them and first. Okay, it doesn't matter whether they're second or 10th, they would still get the base grade of 85% because their game to date best in industry score is exactly halfway between first and last. Okay, the reason I do it that way is a question of motivation. If, for example, the grading was based on first place, second place, third place, it's possible, and this has happened before, that first place is so far ahead that second place can't possibly catch them. And second place is doing well enough that third place can't possibly catch them, right? At whatever point in time that happens, at that moment, the second place team can just give up and not do anything anymore. Because if their grade is based on being in second place, that's not going to change. They don't have to do anything, okay? Clearly that's dysfunctional, because we should all try to always be motivated and incentivized to continue improving. Okay, so in that hypothetical scenario, if second place can't catch first place, they still have an incentive to keep trying to do better, because if they can close the gap, if they can get closer to first place, that's going to improve their grade based on this distribution. Okay, same thing with that third place team. They can't catch second, but if they can at least get closer, if they can move up in terms of this game to date best in industry, their grade's going to improve. Okay, so it's a question of making sure you have an incentive to always try to do a little bit better. Okay, so those are the base grades. There is a modifier that's based on stock price. Okay, so keep in mind that you're coming in and taking over companies that have already been in operation for a number of years. So you're publicly traded, you're already out there on the stock market, and on the day you take over, you're trading at a stock price of $30 per share. Okay, like we've talked about so many times, your objective is to generate returns for the shareholders, not just returns, but abnormal returns, right? Bigger than what the investors could have gotten by giving that money to one of the competing companies. Okay, let's say that you fail to do that. Let's say you actually destroy shareholder value, meaning that your stock price at the end is lower than it was when you took over. Okay, clearly that's a failure of strategic management, and that has to be recognized in the grading. Okay, so if at the end of the simulation you end up with a stock price that is lower than $30 per share, what's going to happen is you're going to have a 10% penalty on your grade. Okay, on your performance grade in the simulation. All right, so what that means is, worst case scenario, you are the last place team in terms of the game to date best in industry score, and your stock price ends up below $30, then you'd get a 60% grade for performance, 60% of those 200 points that are available. Okay, now with this penalty, the fact is nobody has to get it. It's entirely possible that every company in this industry is going to create at least some shareholder value. The stock price will go up at least a little, right? It could be that some companies end up at the end with a stock price of $32. There will be other companies that end up with stock prices of $300, $400, $500. But at least everybody added some value, not nearly the same amount, but at least some. in that case, nobody gets this penalty. Okay, and that happens. It's also possible that multiple companies will get this penalty, right? So maybe the last place team here in terms of the game to date best in industry has a stock price below $30, but the next to the last company might also, or the company that's above them might also have stock prices all below $30 a share. In that case, all of those companies would get this 10% penalty off of their base performance grade. Okay, so let's say based on this distribution and this calculation, the way I've described it, your company would end up with a base grade of 75%, but your stock price is $25, then your final performance grade would be 65%. So a 10% penalty from the 75% base grade. Okay. All right. So game to date best in industry. It's how do you compete? How do you compare to the other companies in the industry over the long run in terms of earnings per share, return on equity, image rating, credit rating, and stock price. It's not about volume. It's not about market share. Obviously, those things matter, but you can achieve the objectives, strategic success, without being the biggest dog in the fight. Okay, and it's based on this kind of a distribution. Okay, the team that does the best gets the most points. The team that does the worst gets the fewest. Okay, which is hopefully everybody recognizes the way it ought to be. Okay, so that's that. Like I said, check out Blackboard. There's a document with a specific example of what this looks like in a particular industry, past industry. Okay, but if you have any questions, please don't hesitate to let me know. Thanks.